welcome back. You're watching Buy Now, Sell Now, and then let's talk about Berger Paints and its Q3 numbers, majorly in line. And but then let's figure out what's going to be the volume growth guidance for the upcoming financial year and also the last quarter of the financial year, and a lot of other in the pipeline. We are joined by Abhijit Roy, MD CEO Berger Paints. So, Mr. Roy, hi, morning, and welcome to the show. Let's talk about EBIT margins. Have declined slightly in Q3, but your peers have reported good numbers. Just wanted to know what led to this pressure and what is the outlook now going forward?
So the margins this quarter was, the gross margin was the highest actually in the last 15 quarters. And if you look at the EBITDA was in the guided range of 15 to 17%. It came at 16.1. Last year it was at 16.2. So it's just at that same level. Between the gross margin and the EBITDA, the difference came because of basically the scale effect, that the sales, was muted, and therefore the overhead expenses were apportioned over much lower value, and hence the EBITDA otherwise would have been higher, but it came at 16.1, which is still good, which is just about same as that of last year. As far as guidance is concerned, we have always maintained that we will be in this range of 15 to 17%, in the EBITDA to sales ratio, and that we hold, even now. Possibly in the revenue side, we will see an improvement this quarter. The growth rates will be better than what it was in the second quarter and the third quarter.
Right. Hi, so this is Ankita also joining in. Tell us the volumes and the value gap that widened to 8.1% from an earlier 7.7% in the quarter 2 of FY26. Is there any pricing pressure over there?
So the volume and value gap that you see is an account of three factors actually. One is the mix itself. Currently we are selling a large quantum of products like tile adhesive. Then you have texture coatings, admixtures. These are much of them is actually construction chemical and waterproofing products, which is used, in the construction industry. Now, that volume and the growth being higher, that is what is reflected in the volume growth. Also, the fact that there was a price drop in the lower end emulsions, which the industry took, which was about 2%. The mix change impact is about 3.5%. So therefore, you have about a 5.5% coming in out of that, and then we spent a little bit more money in the painter schemes, etc., which we have about 1.5% was there on that. So that's what accounts for the volume value gap.
You've reported a volume growth of 8.5% in Q3. What will be the volume growth guidance now for FY27?
Possibly will be better than what we registered. We registered about 8.5% last quarter. It possibly will be in the double digit this quarter and going forward as well.
Right. Also, tell us how has been the demand in the early quarter 4 of FY26?
The demand looks improving, so what has happened is from October, November was better, from November, December was better, and from December, January has been slightly better. So progressively it is improving, and we expect that this trend will continue going forward as well.
Now, let's talk about the market share that fell marginally from 19.6 to 19.4. Is this because of high competition? Also, can we expect more decline going forward? What is the outlook on market share that you have set for yourself?
So obviously, there is a plethora of competitors who are coming, and and some of them are spending money, because they don't have to worry about the profit. So obviously, there will be some impact, right? We have maintained our margins. The gross margins, as you saw, was at the highest, in the last 15 quarters, and at the same time, we have been nearly been able to hold on to our market share. We haven't lost anything significant, and we expect that we should be able to claw that back as well in the next year.
Right. Also, talk to us about your Capex. How much of the Capex you have utilized in 9th month of FY26 and where? And going forward also, what is the Capex outlook?
So as of today, in Q4 FY26, there won't be any great capex. Whatever small issues which are there in our existing factories, we will be spending money there. We will have in FY27 some amount of spending for the Panagar plant and FY28-29 for the Orissa plant. So this is as of now the plant. All of it or most of it will come from internal generation. There will be no borrowing, and that's how we have planned it.
Any numbers you can share what will be capex spend for FY27 and FY28?
So total spend in the next 3-4 years will be about 1800 to 2000 crore. It will be in phases, and therefore it will be well spread out between these 3 to 4 years.
Also, talk to us about how has the growth in the premium and the luxury segment in Q3 FY26 been, and going forward, which is the segment that you see more growth coming from?
The premium growth has been very strong. The luxury growth has been muted. We expect that the luxury growth will also pick up soon, and therefore going forward, both premium and luxury should be growing well.
All right. How is the urban versus rural demand shaping up?
So more or less on similar lines, there is no great difference between rural and urban. However, since we have taken up a special program on the urban market, we are seeing initial green shoots already, and we are quite hopeful that next year when we get into from April onwards, the urban markets for us will register much higher growth rate.
All right, Mr. Roy, thank you so much for joining us today with the numbers and the growth roadmap ahead. We'll let you go on that note. And with that, it's time to pull the curtains on this edition of Buy Now Sell Now. Kavita and I will take your leave. Thank you so much for tuning in.